Hi, I'm Anastassia Fedyk. I'm at UC Berkeley, the House School of Business. I'm a finance professor there. And what I research is how firms invest in new technology, especially artificial intelligence, and then what happens to the firms, what happens to the workers, and what happens to the broader industries. So in this paper, we're interested in understanding how when firms invest in artificial intelligence, AI, how that changes their systematic risk, their correlation with the broader market. Are they becoming more procyclical or are they becoming less procyclical? And of course, there are reasons to expect either. It might be that as firms invest in AI, they're able to forecast better, they're able to weather different shocks better, so they're less sensitive to the market movements. On the other hand, it might be that as firms invest in AI, they actually become more correlated with other firms investing in AI because they're using similar data sets, similar methods, relying on similar third-party dependencies like cloud computing, or it might also be because of innovation, because these firms are investing in something that is effectively assisting their future innovation, this AI technology, and innovation allows them to expand during good market conditions, producing more products, selling more, but of course with a little of a cost paid in bad market conditions. That might also drive them to be more procyclical, so have a higher correlation with the overall market. That's a great question. And first, let me give you a spoiler about what we actually find. So we find that firms that invest in AI are becoming more correlated with the broader market moves. So they're becoming more procyclical. Their market beta, what we call it, goes up. We do not see this result for other adjacent technologies, for example, for IT or for robotics. Now, why? Why does this seem to be unique to AI? And that comes to the mechanism that we think is going on behind our results. So we think that the reason that AI is associated with an increase in the firm's correlation with the market is because of innovation. Basically, we find in our research that the primary use of artificial intelligence by firms to date, so the first decade, has been expansion and product innovation. Those firms are producing more products, they're producing more varied products, they're selling more, they're getting more market share as a result. There's a lot of innovation going on. So investing in AI is like investing in a growth option. It's investing in the option to innovate, to produce new products when the market is doing well. And that, of course, makes this company more procyclical. Other technology like IT and robotics does not have as strong of a link with this innovation channel. So that's why we don't think we see the same effects going on in those other technologies. Yeah, so we think that this is also part of that innovation channel. Basically, the reason that the market beta of AI investing firms goes up is because they're investing in this option to innovate in the future and produce more when the market conditions warrant it. And so that's why we see a twice larger increase in market beta on the upside, so when the markets are up, than on the downside, so when the markets are down. The reason is that that's the primary channels, that this innovation expansion during good market conditions. Now, those firms are also paying a little bit for that innovation by investing in AI, and that's what's driving the downturn beta as well, but that effect is not as large as the upside. Now, what do we draw as a conclusion from that? Well, we point out that this means that the systematic risk that we observe in AI investing firms, that these firms become more correlated with the market, is not necessarily a bad thing. It's not that these firms are somehow becoming more fragile, more dependent. It's actually pointing to a very positive channel, that these firms are innovating more, and they're capturing more of the upside. That's a great question. And actually, the result that we find that we think is most relevant for policymakers is not so much the increase in beta by AI investing firms, but rather the increase in market share and the uneven distribution of the effects across firms of different sizes. So this is something that we actually observed in our previous paper with the same co-authors, where we looked at the effects of AI in firms' sales and employment. We saw very positive effects, but what we observed is that those positive effects were present for the largest firms. For the medium-sized firms, they were lower, and for the smallest firms, they were actually non-existent. So basically the benefits from investing in artificial intelligence are going to be larger for those firms that are already big. Why? Because they have the data and the resources necessary to really leverage that technology and to make the most of it. Smaller firms just don't have as much data and as many resources. And so as a result, what we observe is that at an industry level, investments in artificial intelligence are associated with increased industry concentration. And that is something that is, I think that regulators should watch out for, because so far we haven't had much of an effect in terms of pricing, margins, so those firms have not yet drawn monopolistic power from it, but it's something that may happen in the future, and of course concentration is always something to be wary of. So that would be where we think policymakers should pay the most attention. Yeah, and again, the risk effects that we find are not necessarily bad, right? This is just about those firms expanding, finding growth options, mostly correlating with the market on the upside rather than the downside. So overall, the effect of AI is positive for firms, but definitely business leaders thinking about investing in AI need to think carefully about what type of firm they have. Coming back to those size effects, smaller firms to date haven't benefited as much as larger firms. So if the firm doesn't have the resources, the data, everything in place to really make use of that technology, then it may be a waste to invest in it. It may also be a waste if they don't have the applications for it, right? What are they using AI technology for? And then, of course, across different industries, different firms, the effects may be different. So overall, the primary effect that we've seen to date is innovations, that firms invest in AI to be able to innovate, to produce more, to discover new products, say new drugs in the pharmaceutical industry, or new machinery in a more machine-heavy area. That's what goes on in most industries. But there are also some sectors where the primary use may be automation. For example, I have a paper with another set of co-authors on audit firms, where there really isn't that much scope to produce new products, and where the task is very close to what artificial intelligence does. It's prediction, it's anomaly detection. And in that sector, what we see is that artificial intelligence is primarily improving the quality of the product, improving the quality of the audit process and the outcomes, but it's also associated with a reduction in employment a few years down the line. So there are some tasks, some sectors where AI may replace human labor. In most sectors to date, that has not been the case. In most sectors, it's actually complementary to human labor, because as firms invest in AI, they produce more, they discover more, they need to hire more workers. But that is something that's going to depend on the sector. It's going to be different for different firms. So it's just really important for business leaders to think about what type of firm, what type of product, what type of data they have, and then whether and how this technology is going to be effective for them. Yeah, that is, of course, a great question and something that I can only speculate about as we're looking forward. To date, I don't think that we've seen that much of a change in terms of how firms are using AI. But that said, the technology has so far been mostly leveraged for innovation, for looking for new products, creating new products. It's possible that as the technology becomes more widespread and also starts being used in less innovation-intensive tasks, that it might start to look more like the old school technologies like IT and robotics that we discussed at the beginning, where innovation is not necessarily the primary application, where it's more about just making the tasks easier for the workers to complete. If that ends up being the case, then of course we're going to see less of an innovation-like profile for those firms' risk.